I'm Steve Spencer from SMB Capital. In today's video, we're going to answer a question I received on Twitter. The question is, why should we check out the futures pre-market? Can you make a video on how to analyze futures pre-market correctly? Thank you. Got this on Twitter yesterday. I thought it was a really good question. As short-term equities traders, we can actually use the S&P E-mini futures contract to make trading decisions to help us during the day. So if you're interested in learning how to use the S&P futures to help you make short-term trading decisions in the stock market, stick around. Before we get started, I'd like to remind you that we have a 2-hour free workshop. And if you check out traderworkshop.com, we have our stock selection process and 3 low-risk, high-reward setups. Check out the link above or check out the URL below. It's free. Okay, so today's question I thought was great. Somebody who wanted to understand how to use, and when we talk about the futures, we're talking about the E-mini. This is the E-mini contract for the S&P futures. This is represented in the stock market by the ETF, the SPY, the SPY. And so the charts that we're going to check out today, when I give you an example, will be for the SPY chart. But that E-mini futures contract will move in sync with the SPYs up and down all day and also in the pre-market. So the question is, why should we look at the E-mini futures in the pre-market? How can we use that to help our trading? So there's a few things. Number one, looking at the futures contract in the pre-market is going to give us an indication as to whether or not stocks are going to open higher or lower. And so if we come in the morning, the stock market opens in New York time 9:30 Eastern time. And if we come into the desk at around 7:38 in the morning and the futures are up 10 points, that would be the equivalent of $1 on the SPY, we'd expect stocks, many stocks, to open higher on the open. And so this can be very useful from a technical standpoint. Let's say, for example, we have a bunch of technical setups we're looking at, stocks that are near resistance that we're looking to get long on breakouts. That gap in the S&P futures could help us get into a breakout trade or be prepared to get into a breakout trade when the market opens, or vice versa. Maybe there's a stock that's been weak recently, futures are gapping higher. We'll use that to alert us to the fact that perhaps we can enter at a good higher price on a good short setup as well. So that's just one basic way that we can use pre-market gaps to kind of help us on technical setups. Then there's the actual making trades via the SPYs themselves, and then using the levels that the futures are showing us in the pre-market. So it's going to help us just make informed directional biases off of highs or lows being breached from the pre-market, as well as looking for a bounce play. A bounce play is when the futures are gapping lower, and when the market opens and the SPYs come down to that pre-market low on the futures, we'll look for the SPYs to stabilize and perhaps capture a bounce. If the market had moved lower the last few days and the futures are gapping higher to a prior resistance area, perhaps when the market opens, if it's below that pre-market low, we'll use a move up to that pre-market high on the futures to get short or look for a failure. So those are just a few examples that we can use. And then also there's times in the pre-market that we need to pay attention to as well. I mentioned already that the US equities markets open at 9:30 Eastern time, based off of East Coast time in the US. But we have important times in the pre-market before the US markets open. Number one, we have when London opens. For most of the year, that's going to be at 4:15 a.m. And we can see when London opens that the S&P futures contract will move. It will move up, will move down, and may establish an overnight, what we call an overnight low or an overnight high. And then several hours later, at 8 a.m. Eastern time, institutions will start putting in orders. And that also can be a good time to establish a high or a low in the pre-market, also levels to trade against for potential breakouts. And so when we look at the pre-market chart, I will show you the London open, I will show you the 8 a.m., and then also when the market opens. And those are going to be key times that we may use as well for a trade. Now, having gone through all of that, it's very important to note that when the market, like it's been recently, is in a low volatility uptrending time frame, I don't really spend much time thinking about what the futures are doing in the pre-market. Unless we're gapping significantly higher than the prior day's close or significantly lower than the prior day's close, then I'll make a note of that. But for the most part, in a low volatility environment, this is not where our focus is going to be. Our focus is going to be in the most in-play names. That's where the price action is going to be. Now, if you're a futures trader, you're an E-mini trader, obviously you're going to make trades in that market every single day. But as equities traders, we're only going to give a lot of our attention in more volatile market periods. That's very important to keep in mind. Let us take a look at an example. So the last decent pullback we had in the market really was in early March, March 8th. We had moved up to around 280 on the SPYs, 281, and we were in a range between around 278-ish to 281. And we had a pretty good pullback after having a hard down move from 281 to 278 to the bottom of that range we're looking at here on the 30-minute. And then when that was breached a couple of days later, we had a pretty hard downtrend day, and that's what we want to zoom in a couple of days later. So if we zoom in, what we can see is a couple of day period here. Number one, on the 30-minute, we sold off really hard when we got down below 278. We bottomed out around 274.5, and then the next day, we actually gapped lower below the prior day's low. And so I've highlighted for you in the pre-market what happened on the London Open. We were at the London Open, we were actually at the prior day's regular trading session, the low, and then we started to come off a little bit as London opened. And then at 8 a.m., you can see we started to move up, but we couldn't get above where we were at the London Open, and we sold off very hard in the pre-market. Actually, we came off looks like about $2.50, and we put in a low right before the market opened. And so now we were able to use those prices from the pre-market to basically look for where a potential bounce would move up to, and then also for a potential buying opportunity, because the setup basically is the prior day we had a downtrend day, and after we have a downtrend day, if we gap lower, we use the pre-market or the overnight low as a spot to potentially look for a bounce if it is a significant gap lower. So you can see from 8 o'clock to 9 o'clock, we come off really hard. The market opens. We basically about $1 above that level. When we came off quickly into that, I got long. And then over the next hour, we had a pretty good bounce. The tricky part of this day was when we had a retest later in the morning, or actually in the midday, we came back and tested the pre-market low again, but it did hold, and eventually at the end of the day, around 2:30 to 4 o'clock, we had a big bounce. Notice in that very big bounce, which ended up being several dollars, we initially got to the 8 a.m. high, and people were prepared to sell there. We came off very quickly $1, then closed above. So these prices from the pre-market, both the 8 a.m. High, where we sold off from pretty hard, and the pre-market low, ended up really being the most important prices of the day from a risk-reward perspective. And so that's kind of how we use the pre-market futures in a volatile period. And vice versa, if the market had sold off several days in a row and we'd bounced back up and we were gapping higher in the pre-market, we would use that pre-market high as a spot to short against, assuming the market opened lower.